Welcome to the UAE specific module on the chart of accounts, often called the backbone of an accounting system. In this section, we'll explore what a COA really is, how it's structured, and why it matters for your business operations in the UAE. We'll use real UAE-based examples such as recording purchases, salaries, or VAT entries, so you can clearly see how each account works in practice. By the end, you'll understand not just the categories, but also how they connect directly to compliance with the UAE's Federal Tax Authority and corporate tax rules. Let's begin. Think of the chart of accounts as your business's financial blueprint. It's the structured list of all accounts you'll use to record transactions, whether you're paying staff salaries, purchasing raw materials, or issuing a sales invoice. In the UAE, the COA has an additional layer of importance. It ensures transactions are recorded in compliance with federal reporting standards, especially VAT and corporate tax rules. Without a well-designed COA, businesses risk misreporting VAT or failing audits. Each account in your COA has a few key building blocks. The account code is a unique identifier. For example, 1200 for cash. The account name should be descriptive, such as cash on hand, or VAT Payable, which is especially critical in the UAE, where VAT reporting is mandatory. Then comes the account type: asset, liability, equity, income, or expense. Finally, notes can be added for additional context, like indicating that VAT Payable is due within the next FTA reporting cycle. This structure ensures your books remain transparent, organized, and audit-ready. A well-organized COA isn't just for internal tracking. It's critical for compliance in the UAE. It ensures income and expenses are recorded accurately, so VAT returns and corporate tax fillings are correct. With a strong COA, you can generate reports that reflect true business performance, set accurate budgets, and forecast growth. For example, if you record expenses without separating VAT, your VAT return will be inaccurate and could trigger penalties from the FTA. The COA is structured into 5 main categories. Assets are what your business owns, like cash or inventory. Liabilities are what you owe, like supplier invoices or VAT payable. Equity represents the owner's investment. Income tracks your sales and services, while expenses cover costs like rent, salaries, and utilities. Let's look at a UAE example. Suppose you purchase products for resale worth 100 dirhams plus 5% VAT. The entry would be debit 100 dirhams, product purchased, inventory, asset. Debit 5 dirhams, input VAT, recoverable tax, asset. Credit 105 dirhams, accounts payable, liability to supplier. Notice how VAT is recorded separately to ensure correct reporting to the FTA. The debit and credit sides balance, demonstrating how transactions flow through the COA. In the UAE, VAT must be tracked through 2 separate accounts. Input VAT is the tax you pay on purchases, which is usually recoverable from the FTA. Output VAT is the tax you charge customers when selling goods or services, which you must remit to the FTA. For example, when buying office supplies worth 200 dirhams, plus VAT, you record input VAT of 10 dirhams. When selling goods worth 1,000 dirhams plus VAT, you record output VAT of 50 dirhams. At the end of the VAT period, the difference is either paid to or reclaimed from the FTA. Keeping these accounts separate ensures your VAT return is accurate and avoids compliance penalties. To summarize, the chart of accounts is the foundation of your business's financial system. It keeps records clean, supports budgeting, and ensures compliance with UAE laws, including VAT and corporate tax. By designing it properly, with clear account codes, VAT segregation, and category organization, you build a financial system that is not only audit-ready, but also a reliable tool for business growth. This theoretical knowledge is what you'll later apply in practice when you demonstrate accounting in UAE systems.